You are highly intelligent. You have devoured every book on supply and demand, volume profile, and proprietary indicators. Yet you are still stuck. The truth is, the reason 90% of traders fail has nothing to do with their technical analysis. It has nothing to do with the specific moving average they choose or the color of their charts. They fail because they fundamentally misunderstand the game they are playing. They believe the market is a puzzle to be solved. It is not. The market is not testing your intelligence. It is testing your character. The unseen barrier is internal. It is the subtle, corrosive weakness that manifests only when real capital is on the line. You can draw perfect trend lines in simulation, but the moment you feel the fear of loss or the intoxicating rush of premature profit, your perfect plan vaporizes. Your ego demands certainty, and the market offers only probability. This is the ultimate trap for the highly analytical mind. They try to control the uncontrollable. They are brilliant, but they are emotionally brittle. Think about your best week. You followed the rules. You felt invincible. Then, without warning, you gave back half of those gains in 2 chaotic hours. Why? Because after 3 successful trades, you stopped viewing the market as a casino, a place where expected value plays out over hundreds of trials. You started treating it like a vending machine. Put in the dollar, get the reward. The moment the market fails to deliver, you break discipline. You chase, you revenge trade. You betray the system that just made you money. This self-sabotage is the true unseen barrier. It is the moment where the internal conflict becomes externalized in your trading account. We are talking about a concept so devastatingly simple, you will resist it with every fiber of your being. It is the single most powerful shift you can make, but it requires the death of the personality you believe you are. To cross the chasm into consistent profitability, you must accept something that feels completely counterintuitive. You must learn how to truly surrender. The resistance you feel is the human animal fighting for its most cherished illusion, certainty. We are wired to predict. We need to believe that if we follow steps A, B, and C, result D is guaranteed. This deep, primal need for a predictable outcome, this craving for certainty, is the single greatest destroyer of trading accounts, and it is the reason you are still stuck cycling through systems. You are not looking for an edge. You are looking for permission. Look at your charts right now. Are you stacking indicators? Are you waiting for the perfect confluence of the moving average, the volume spike, and the relative strength index crossover? You are searching for the mythical perfect entry point that proves your analysis is infallible. This is the hallmark of the intermediate trader, the endless, desperate pursuit of the entry that cannot fail. You believe that if you wait just a little longer, if you analyze just one more fundamental metric, you can eliminate risk entirely. You cannot. Risk is the currency of the market, and every time you try to eliminate it, you eliminate the opportunity for profit along with it. You are operating under what I call deterministic thinking. You believe that because X event occurred, a break of resistance, a news catalyst, it must lead to Y outcome, a sustained rally. You treat the market like a clockwork mechanism, where every action has a single, predictable reaction. But the market is not deterministic. It is probabilistic. The market does not care how many hours you spent backtesting your setup. It does not care that your technical analysis framework was technically correct. It only cares about the capital you are willing to risk when your analysis fails. And yet, your ego demands validation. This is why revenge trading feels so compelling. When a trade fails, it is not just a monetary loss. It is a profound assault on your self-image. Your analysis, your intelligence, was wrong. And what do you do when your certainty is challenged? You double down. Just one more trade, you tell yourself. You are not trying to make money with that second ill-fated entry. You are trying to validate the analysis that failed moments ago. You are trying to force the universe to conform to your expectation, using your capital as the blunt instrument of your will. This is the addiction to being right. But the market is not here to validate your ego. It is here to absorb your risk. The only thing the market truly cares about is risk management. It cares about position sizing. It cares about your exposure. It does not care about your conviction. The ultimate, most painful expression of this addiction to certainty is the moment you move your stop loss. Think about what you are doing in that single panicked action. You are not managing risk. You are fighting reality. You are rejecting the fact that your analysis in this single measurable instance has proven irrelevant. When you move that line, you are telling the market, I am not wrong. You are. You are sacrificing your capital on the altar of being right. You are proving that your need for certainty is more powerful than your desire for consistency. But until you understand the true nature of risk, until you fully accept that the outcome of any single trade is random noise, you will never see the power of the probabilistic mindset. A mindset where being right is simply a byproduct of managing the moments when you are inevitably, gloriously wrong. To achieve true consistency, you must stop trying to be the fortune teller and start embracing the role of the risk manager. And that begins with the most painful acceptance of all, the fact that you already know the answer to your trading problems. You just refuse to look at the data. You refuse to look at your own trading journal. You refuse to see the truth of your own behavior. The truth is sitting in your trading journal right now, staring you down. And it is far more uncomfortable than the screen time you spent analyzing moving averages. The uncomfortable truth that your journal reveals is not a failure of strategy, but a failure of mathematics. You are trying to force certainty into a system built on uncertainty. You are trying to predict the unpredictable. And this is the core concept that separates the consistent from the perpetually struggling. The absolute, undeniable irrelevance of the single trade. 90% of traders fail because they treat every single entry and exit like it is a life or death moment, a personal referendum on their intelligence. They demand that this trade must work. They demand validation from this outcome. But the market does not care about your needs, your hopes, or your demands. It only cares about probability. If you cannot accept that the next trade, the one you are looking at right now, might be a loser, then you have not internalized the power of the law of large numbers. This law dictates that your edge, the slight statistical advantage your system holds, is not a magic spell. It is not a guarantee. It is simply a slight tilt in your favor, visible only across a vast sample size. Think hundreds, even thousands of trades. Your edge only exists in the aggregate. In the short term, the market is fundamentally random. It is pure noise. You cannot control what happens next. You cannot even accurately predict what happens next. And yet, you spend all your emotional energy trying to. You are looking at one snowflake and trying to deduce the future trajectory of the entire blizzard. Stop trying to micromanage the universe. Your only job is to ensure the integrity of the process. That is it. Your strategy is designed to make money over 100 trades. Not one. If you are focused solely on the outcome of the immediate position, you have already guaranteed the failure of the sequence. Imagine you are flipping a coin that is slightly weighted. It lands on heads 55% of the time. That 5% edge is your statistical advantage. If you flip that coin 1,000 times, you are statistically guaranteed to end up ahead. You will make a profit. But if you stop after the third flip, and it happens to be 3 tails in a row, you walk away convinced the system is broken. That is exactly what happens when you trade. The market is not obliged to give you a winning result on the very next entry, even if your strategy has a 60% win rate. If you panic after 1 or 2 losses, if you start adjusting your stop loss or your position size based on the fear that the next flip will also be tails, you have destroyed your mathematical advantage. You have ruined the game. The weight of the coin, the edge, only exerts its power over time. The single trade is noise. The system is the signal. Your emotional attachment to the outcome of one single trade is the guaranteed failure mechanism of the entire sequence. When you allow fear of missing out or greed to dictate the management of one position, moving a stop loss, adding to a loser, you are sacrificing the statistical integrity of the hundreds of trades that follow. You are saying, I need this one to validate me. This desperate need for validation is the poison that leaks into your execution. If you have done your backtesting, if you have defined your edge and calculated your expected value, then your job is reduced to a single mechanical task: flawless execution of the next signal. That is the only thing you have control over. You do not control the market. You only control your entry, your stop loss, and your take profit levels. Everything else is outside your jurisdiction. The truly great traders understand that winning means accepting the inevitability of losing the individual battle. They treat a winning trade and a losing trade with the exact same emotional detachment, because both outcomes were already factored into the statistical model. They are just data points. They are just flips of the coin. If you cannot accept the loss of a single trade, you are fundamentally rejecting the law of large numbers. You are insisting on certainty where only probability exists. And until you accept that the single trade is irrelevant, you will continue to chase noise. You will continue to sabotage your own system, trade by trade, loss by loss. But if the single trade is irrelevant, what should you actually be focusing on? If the outcome of the next position doesn't matter, what does? The answer is far simpler and far more difficult than you think. It is the only thing standing between you and consistency, and it is entirely internal. It is entirely internal. The barrier is not technical. The barrier is the ego. The human mind is a narrative machine. It demands causality. It requires a story where actions lead directly to predictable results. When applied to trading, this means the ego must find a reason for everything. If you take a position and it moves immediately in your favor, the ego instantly claims credit. It wasn't the system, it was your genius. It was your intuition. You saw what others missed. This need for credit is precisely what prevents you from accepting the law of large numbers. If you accept that the outcome of any single trade is statistically random, if you accept that sometimes you are simply lucky and sometimes you are simply unlucky, the ego cannot define itself by the outcome. It cannot tolerate the truth that your intelligence had nothing to do with whether that single position moved 5 points or 50. This mechanism works in reverse too. When a trade goes against you, the ego refuses to accept responsibility for the probabilistic outcome. It blames external forces. The market makers are manipulating the price. The news was unexpected. The broker is hunting your stop loss. It is always the fault of the environment, because if the loss was merely a random statistical event inherent to the edge you run, then the ego has no narrative to cling to. It becomes irrelevant. This need for definition is the fatal resistance faced by every intermediate trader. The probabilistic mindset requires profound humility. It demands that you treat yourself as a statistical operator, a machine executing a positive expectancy edge over a long series of trials. The moment you accept this, your trading becomes mechanized. It becomes a process executed with detached discipline, and the ego fights this automation tooth and nail. This realization terrifies the average trader. The ego fears failure, certainly, but far more dangerously, it fears success gained without the validation of its own superior judgment. If the system works without your constant, clever intervention, what are you? You are merely the consistent operator. You are the executioner. And the ego is convinced that it is more than that. It is convinced it is the oracle. This internal civil war manifests externally as sabotage. This conflict is why you oversize positions, desperately trying to force the system to acknowledge your skill by creating outsized returns immediately. This is why you abandon a perfectly valid system the moment it hits a standard drawdown, because the ego blames the tool, not the execution. It is why you suffer from fear of missing out, because the ego is convinced that this specific move, the one you didn't take, is the specific one that only your intuition could have caught. Every deviation from your written process is the ego trying to reclaim control over a game that, at the micro level, is inherently uncontrollable. You cannot manage randomness, you can only manage your response to it. The paradoxical wisdom that separates the few from the many is this: To gain total control over your long-term equity curve, you must first surrender all control over the next 5 minutes. You must accept that your job is not to predict the market, but to execute the edge with robotic consistency. If you cannot surrender the need to be right on the next trade, you will never achieve consistency over the next 1,000 trades. Your focus must shift from the outcome of the position to the purity of the execution. The question you must answer right now determines if you will be the 90% or the 10%. Are you trading to consistently compound wealth through flawless, detached execution? Or are you trading to prove to yourself and the world that you are the smartest person in the room? The answer to that question will define whether you treat the market as a casino or as a probability engine. And that distinction leads us to the final, necessary step: how to build the inner firewall that allows you to execute an imperfect edge perfectly. That inner firewall is built not of willpower, but of mechanics. It is the practical application of radical detachment. You cannot simply decide to feel less. You must structure your exposure so that the potential loss is psychologically meaningless. This begins, and often ends, with position sizing. The size of your position dictates the size of your emotional response. If you are trading a size where a single loss forces you to question the validity of your entire strategy, or worse, if a loss compels you to immediately chase the money back, your size is catastrophic. Most traders size their positions based on the potential profit. They calculate what they stand to gain. This is fatal. You must size based on the absolute worst-case scenario, the loss. The position must be small enough that when the inevitable stop-loss is hit, the event registers as nothing more than a click on the screen, a necessary input into your overall statistical engine. This requires a mental separation between your trading capital and your risk capital. Your trading capital is the pool of resources you manage. Your risk capital is the specific amount allocated to this single current experiment. The moment you enter the trade, you must mentally write off that risk capital. It is gone. It is a sunk cost. It is the price you pay to participate in the probability distribution. If you are still mentally trying to save the trade, or if you feel a surge of regret when the price moves against you, you have not accepted the risk. You are still operating under the delusion that you can control the outcome of a single event. The true assessment of your detachment is found in what we call the next trade test. When your system dictates that you must exit a trade for a loss, how quickly and cleanly can you shift your focus to the next potential setup? Does the pain of the previous loss corrupt your perception of the current opportunity? Do you hesitate? Do you flinch? If the sound of your stop-loss being triggered accelerates your heart rate, if it causes that familiar clenching sensation in your chest, you are failing the test. That physical reaction is the ego screaming because you are still gambling for validation. You have not accepted the law of large numbers. The law of large numbers dictates that your edge only expresses itself over a high volume of trades, where losses are necessary, unavoidable data points. If a loss feels like a personal attack, you are not trading a system. You are betting your self-worth on every single flip of the coin. You must stop seeing yourself as a trader and start seeing yourself as an operator. You are the engineer running a complex, stochastic machine. Your job is not to predict the next output, but to ensure the inputs are clean, the machine runs on schedule, and the quality control is flawless. An operator does not curse the machine when it produces a loss. The operator checks the checklist, verifies the trade met all criteria, and moves on to ensure the next input is perfect. The outcome of any single trade is irrelevant to the operator because the integrity of the process is the only variable that matters. Your goal is not profit on this trade. Your goal is flawless execution of your edge. When you finally achieve that level of detachment, you will unlock the final, most painful paradox of consistency. The understanding that to truly win, you must sacrifice the very thing you entered the market seeking, the thrill of being right. That sacrifice is the freedom you've been chasing, because the moment you accept that the market is inherently non-deterministic, that the next tick is truly random and unknowable, the entire structure of emotional trading collapses. You stop believing that you can force a result. You stop believing that you deserved the win or that the market owes you a recovery. The desperate need to engage in revenge trading, that frantic chase to get back what the market supposedly stole, vanishes completely. Why would you seek revenge against a random number generator? It is an act of madness. When you surrender the illusion of control, you gain mastery over the only thing you ever could control, your own response. This is where fear of missing out dies. Fear of missing out only exists when you believe there is a predictable future that you are failing to grasp. When you see a huge move you weren't positioned for, the old trader screams, "I missed it." The professional simply notes, "That was a random outcome I was not positioned for." My edge dictates waiting for specific criteria. That detachment is not apathy. It is the highest form of patience. True patience is not just waiting for a setup. It is the absolute certainty that your setup will appear, and if it doesn't, nothing was lost. You are no longer waiting for the market to validate you. You are waiting for the data to align. It's a subtle but profound difference that changes everything. When this shift occurs, trading becomes incredibly boring, and that boredom is the sound of professional competence. You are no longer riding the emotional roller coaster of hope and despair. You are running a business process. You are executing an algorithm. The thrill is gone. Good, because the thrill was costing you money. Now let's talk about losses. The intermediate trader sees a loss as a failure, a judgment on their intelligence, or a sign they need to change their strategy immediately. They view it as a personal defeat. The professional sees a loss as the statistical cost of doing business. It is simply the negative side of the expected outcome distribution playing out. You didn't fail. You paid the statistical verification fee required to confirm your edge is still valid. When the market is viewed as a series of random numbers, you stop wrestling it. You stop trying to impose your will on the chaos. Instead, you manage the only thing that works: risk. You ensure your position size is small enough that any single random outcome cannot destroy your entire equity curve. You trust the mathematics. You trust the larger sample size of your tested edge. The market is loud, full of noise, and designed to elicit emotional reactions. But your job is to respond with quiet, disciplined mathematics. This silence, this lack of emotional input, this willingness to accept that you are just a risk manager waiting for the inevitable statistical payoff, this is your new terrifying edge. It is terrifying because it requires you to trust something outside of your immediate feeling of control. It requires faith in the invisible hand of large numbers. You stop trying to be the hero who predicts the future, and you become the accountant who manages the present. This faith, this surrender, grants you true patience. But what does that patience look like when applied to the most difficult variable of all, the dimension of time itself? Patience in trading is not waiting for the perfect setup. It is the acceptance that your edge unfolds over hundreds of trades, not 3. It is the commitment to the long, slow, often boring game of statistics. This is where the 90% break. They see a slow week, their profit and loss statement flatlines, and they immediately conclude the system is broken. They seek the quick fix, the new signal, the guaranteed winning day. They demand certainty in a domain defined by randomness. The 10%, however, understand that the true edge is not in the prediction, but in the persistence. Your commitment must outlast your impatience. It must outlast your fear. And it must certainly outlast the noise of the market itself. This is the final reckoning. 90% of traders fundamentally misunderstand the nature of the game they are playing. They believe they are fighting the charts. They believe they are competing against Goldman Sachs algorithms. They believe they are battling the Federal Reserve. They are wrong. Trading is not a battle against the market. It is a battle against the self. The market does not care about your rent payment, your ego, or your belief that you deserve a win. It simply offers opportunities based on probabilities. The market is perfectly neutral. The pressure you feel when a trade goes against you is not external pressure. It is the internal pressure of your own fear manifesting. The urge to move your stop loss, to double down, to chase a breakout. That is the ego demanding control where none exists. The only thing you can truly control is your entry, your exit, and your risk per trade. Everything else is noise. The one concept 90% will never truly grasp is this. The mastery of trading is the mastery of self under conditions of extreme randomness and financial stress. You cannot learn this by reading a book on candlestick patterns. You learn it by sitting through drawdowns and executing your plan flawlessly, even when every fiber of your being screams at you to interfere. Think of the ocean. The ocean is vast, chaotic, and utterly indifferent to your intentions. You cannot steer the ocean. You cannot command the waves to be calm. The inexperienced sailor tries to fight the current, exhausting themselves. The master sailor accepts the current, but builds a strong, seaworthy ship, calculates the navigation precisely, and trusts the vessel he has meticulously engineered. Your system is the ship. Your discipline is the navigation. The greatest freedom in trading comes from this surrender. When you fully accept that the outcome of any single trade is random, that it is a coin flip, you stop treating it as a life or death moment. You stop seeking the perfect indicator that promises certainty. You stop chasing the Holy Grail strategy. Instead, you focus 100% of your energy on becoming the flawless executor of a proven system. This requires continuous, deliberate practice. It demands that you show up every day and commit to the process, testing your own adherence to the rules. Are you willing to take the 20 losing trades required to capture the one massive winner? Most are not. Most quit on trade number 5, convinced the system is flawed, when in reality, their commitment was flawed. When your profit and loss statement finally begins to reflect your discipline and your emotional stability, rather than reflecting the market's momentary generosity, that is the moment the internal fight begins to shift. You stop fighting the charts. You start fighting the most dangerous variable in your trading life, the self, and that truly is the only fight that matters. But what happens when you win that internal battle? What does it look like when execution becomes automatic? If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.